Investors, welcome back. Troy Cates, the co-founder and managing partner of NEOS Investments, where in this video, we're going to be going over and deep diving into the mind of NEOS Investments, how to navigate this current crazy cover call ETF market, and maybe tips for success for long-term focused, income-oriented dividend investors. So I'm going to throw it back to you, Troy, and welcome you back to the channel.
Thanks for having me. Always love coming on here and talking about ETFs and talking about the income space.
This content is sponsored by NEOS Investments, which is for educational and informational purposes only and not financial advice. What is the origin story of NEOS, and what is the ultimate goal that NEOS is trying to solve in this cover call ETF market?
So where did we start? So the NEOS has been around for a little over 3 years. We launched our first 3 products in August of 22, but the team has been together for a long time. So my co-founding partner, Garrett Paola, and I have worked together for almost 18 years straight now. We worked together on the sell side of the business for a long time, and then we eventually left and we started our first asset management firm where we brought out a lot of the early option-based ETFs to the market. And we eventually sold that business to a large international asset manager and ran their US ETF business for a number of years. We were able to grow that business very nicely. And then they had the opportunity to acquire some more businesses within the sector. And it really wasn't the path that Garrett and I wanted to continue on. So we left there together, went to the private side and worked for a large asset manager, more on the hedge fund side, that had a number of separately managed accounts where they did a lot of option overlays for single family offices, very wealthy individuals, large pensions, endowments. And we worked there for a number of years. And during that time, we really wanted to build out and work in the ETF space again. So Garrett and I really wanted to get back into the ETF space as we started to see the space grow on the active side and really around the active option side. And we started to think about what kind of products we would bring out. And we eventually left that firm to start NEOS a little over 3 years ago. And with that, we were able to bring out our first 3 ETFs in August of 22, which were SPYI, CSHI, and BNDI. And we picked those 3 as really thinking about your asset allocation and slicing up the asset allocation pie a little. We wanted to have something in the equity space, and we thought broad-based equity exposure through the S&P 500 for SPYI. We wanted something in the fixed income side with BNDI, which gives you that core aggregate bond exposure with the option overlay. And then we wanted something in the ultra short duration, more cash alternative space. So we brought CSHI, which is that 1 to 3 month T-bill with the added option overlay. And that was kind of the foundation. But what was important for us was to bring together a team here at NEOS that we could build this with. And so Garrett and I really brought in a number of partners, that people we've worked with for 5, 10, 15 years, to bring them in different departments, whether it was the marketing side or the business development side, or thinking about business infrastructure and operations. And then we started to build out what we wanted for research and trading. And from there, we continued to expand. So think about where we grew after that. We didn't launch another product till January of 24. So almost a year and a half later, before we launched QQQI, which is our NASDAQ 100 product. And during 24, we started to bring out more and more products. We started to grow the team more. We started to get more traction among advisors and individual investors. And we really started to, again, slice up that asset allocation pie, think of more broad-based indexes we could build option strategies on. Think of alternatives, where we brought out our Bitcoin product, BTCI. We brought out our gold, IAUI, real estate, and continue to grow the equity and grow the fixed income products as well. And then we have also our hedge suite with SPYH and QQQH. And so for us, it's really thinking about how do we build a great team that wants to work hard and focus on these products and bring out great products to the marketplace. And also at the same time, bring out these products that resonate with people and say, people look at it and say, I could use this in my portfolio. This is a great way to, whether it's bring in additional income, lower your portfolio volatility, still get exposure to some of these great indexes as we were talking about. And for us, here we are 3+ years later, we have 13 ETFs in the marketplace. We have a number more in registration that we're looking to get out over the next few months. And so it's an exciting time for us here at NEOS. We have over 30 people working here in our Connecticut office. And so for us, it's continue to build the team, put out great products, and continue to move forward and innovate in the space.
QQQI and SPYI have been some of the most popular ETFs by NEOS. So what is it about NEOS's approach that resonates with retail-focused investors compared to other cover call ETFs that are competitors to NEOS products?
I think what resonates a lot is the way we build our products. Think about the original equity product, SPYI. We didn't want to do anything other than track the S&P 500 from an equity standpoint. So people understand that, people accept that, people invest in the S&P 500. So in that part, they could understand it was really talking about what we're doing on the option side. What is our annual distribution target for each product, where people can look at it and say, okay, I'm expecting to earn in the 10 to 12% range from SPYI, for example. And if SPYI can give that to me consistently, and I understand that they're invested in the S&P 500 stocks, and I understand that what they're doing on the option side, rolling this S&P 500 index option on a monthly basis, I could look at that and say, okay, that's going to be more, from some point of views, maybe more consistent on what they're going to earn and what their exposure is. They know they have the equity risk of the S&P 500. They might have a little bit of a lower vol portfolio because of the call writing strategy, and in the flat to down markets potentially outperform the underlying. But in the up markets, I think what's important there, where we're a little different than others, is the way we manage our short calls through a rules-based strategy to try to capture as much of the upside of the S&P 500 or the NASDAQ 100 or the Russell 2000. And I think once they understand what we're doing in one, they kind of understand what we're doing in the other products. And so I think as we brought out more and more products, say SPYI, QQQI, yes, those are our two largest ETFs. And those have done great for us, and we continue to support them. They continue to be large holdings for me and for others personally within the firm. And we look at it as we bring out these other products. They understand what's going on in SPYI. They understand what's going on in QQQI. So when we bring out, say, a BTCI, which we brought out about a year ago, they look at it and say, okay, I understand. They're going to have this long exposure to Bitcoin. They're going to be selling these calls out of the money, but with the heightened volatility of Bitcoin, they're going to sell them further out of the money. They're going to sell on less of the notional, which could potentially give me a bigger upside capture with Bitcoin. And we saw that after the election last year and how much Bitcoin rallied and how much it has rallied after that. And then, of course, we've seen, the past couple of weeks, we've seen a real sell-off in Bitcoin, and we see how it performs then. So I think kind of going through that, people know what to expect from our products if they've been watching us for a while. And, one of the things that Garrett and I really talk about is being available to talk to advisors, coming on channels like yours and talking about these products and explaining to people what they do. Because one of the things we're always kind of pounding the table on is you have to do your homework. If you're going to be investing in this option income space, there's so many products. And Marcus, you go through a lot of them. And you think about how many products are out there in this space. If you include the defined outcome, the buffered products, anything using an option in the ETF landscape, there's, I believe, over 700 of them now. So that's a lot of ETFs to go through. And even if you kind of whittle them down to say you want to look at only a NASDAQ 100 type products or S&P 500 type product, there's still a lot of products out there, and you have to see what is each one doing. Each one, we always talk about all option strategies are not created equally because they're managed differently. People use different products. We tend to, wherever we can, we use index options. We use them for a number of reasons: the liquidity, the transparency of what's in the portfolio, as well as the tax efficiency. There's 1256 contracts, so they get a different tax classification than other options. They get a 60% long-term, 40% short-term cap gain split, whereas other products might use single name options. They might use ETF options. They might use swaps or equity linked notes. And then you start to think about what are those doing and what is that tax efficiency behind it. So for us, it's all about bringing out good products that could have a good distribution and that over time, the total return could support that distribution, and see if we can make that distribution in any way tax efficient to the end shareholder.
What are your thoughts on the current cover call ETF market? like you said before, we're seeing many issuers launch new products, many new products, new issuers coming out, and yields varying from 5% upwards of 100% yields. And some investors aren't, in my opinion, at least retail focused, liking those higher yielding products in the extraordinarily high yields. And maybe they want to go towards a more lower yielding product. It's crazy to say that a low yield is 10, 12%. But what are your thoughts on this crazy cover call market for retail investors?
It's definitely interesting. You see a lot of products come out, like you said, with very large yields. And I think over time, it's really important for investors to do their homework and understand what they're investing in. And if that's makes sense to them, then that's, what works for them. Every investor is different. And I just say, when you're doing your homework, a great way to kind of equalize saying that you're looking at 10 different funds all within the same sector, all within the S&P 500 sector, and you're thinking about investing in one over the other, it's not always the best to look at what the actual distribution is. It's the best to look at maybe what the total return is if the funds have been out for a year, 2, 3 years, whatever it is, and look at what those total return is compared to what the distribution is. And can that total return over time support that distribution? And it's a nice equalizer to say you're looking at fund 1, 2, 3, and 4. What is the total return of each one? Because that includes the distribution that went out. Then you could take away the headline, oh, this one has a 25% distribution versus this one at a 10% distribution. The 25 is not always necessarily the better fund to invest in. In some cases, it might be, but it's really important to do your homework and kind of look through that and understand what makes the most sense. What kind of risk are you taking to get that extra yield? And does that added risk mean more return from a price standpoint over time? Or does it mean too much risk for your portfolio? And so it's important to notice that and think about that when you're building out your individual portfolio.
Why do you think that cover call ETFs have been growing so much in popularity in recent years? Do you think that investors don't feel financially stable, that they have to forego upside to receive income instead?
I think it's grown a lot recently because people are looking for different sources of income. So when you think about the covered call space and how it's grown on various different asset classes, even thinking about the NEOS products, I think we've seen more and more investors come to the space willing to give up a little of the upside to get income off of that underlying reference, whether it's a large based index like the NASDAQ 100 or the S&P or Russell 2000, or it's something like a gold or a Bitcoin. And I think, some people are looking and coming to the space to have lower their overall portfolio volatility. Some are looking for just pure income, and some are looking to supplement their lifestyles, whether they're retired and they need the income and they still want exposure to some of these indexes, or maybe looking at the fixed income side where they can potentially enhance the income coming off that fixed income. So we've seen it across the board. And I think the space has grown just because there's a real need and desire out there for income. And even if you're not using the income and you're reinvesting those dividends on a monthly basis, it still gives you the opportunity to compound and build that over time to where maybe potentially down the road you do turn on that income stream and start to take it. So we're of course happy to see the growth and enjoying the growth. But like I said earlier, we brought out a lot of products over 10 years ago at a different asset manager that we owned. And back then it was a different story. That's when ETFs were really starting to kick in and investors were starting to use them more and more compared to, say, mutual funds or picking individual stocks. And it was definitely a different time in bringing out income products, and people didn't fully understand what we were trying to do with an option strategy inside an ETF. But now that the space has grown so much, that part of the education or sales process is past us, but there's still a good amount of education that needs to be brought about by participants in the sector and by people that are going to invest in these. They need to understand what they're investing in.
Do you think that it's super crucial and important that portfolio managers like yourself and even Garrett own your own products? Because I know some other issuers may not own every ETF product or even any of their own ETF products, but I know that NEOS owns their own products. Is that super important to you? And should other portfolio managers also own their own products?
Listen, it's important to me because of how we're building out NEOS, and we're really looking at ourselves as slicing up that asset allocation pie. So we're looking at it as, our products have a place in most people's portfolios, not in everyone's portfolio. It's not built for everyone. But for me specifically, yes, I own all my products. But it doesn't mean that a manager that has 100 different ETFs should own all 100 ETFs. Maybe they own some of them and don't own others because their individual investing style is different than someone that might own all 100 of those ETFs. So I think in the end, it's down to each individual investor and what they need out of their portfolio, what kind of risk tolerance they have. And like I said, a lot of issuers have 50, 100, 200 ETFs in the marketplace. It does not mean that they need to own all of them. It's up to them individually on what makes the most sense for their individual portfolios, but it doesn't mean they can't put out products that might fit for other portfolios for other people.
What are your thoughts on retirees looking into investing in cover call ETF products? I've seen this as maybe a trend as of recently, and even younger investors going into cover call ETF products where the old saying was invest for pure growth when you're young, and even when you're near retirement, if you're trying to catch up, to try to invest in growth and fixed income rather than cover call products.
So I think, listen, it comes down to the individual investor, but I know plenty of people that are retired and invest in our products or products in our competitor landscape. And they do it knowing what the risk is. But if you have someone that recently retired and maybe they're 65 or 70 years old, they're still looking at, I need to live off of whatever I've saved and whatever my nest egg is and whatever income is coming off of that for the next 20 plus years potentially. And they don't want to just burn through that money and get to a point where they're not able to live off of what they have anymore. So a lot of them have looked to this space and have said, can I be involved in the, making it up, S&P 500, for example, and still have that potential, or the NASDAQ 100 and have a lower vol portfolio and earn income off of that at the same time to help supplement what other income products I have. So for us, it's really just offering more and more solutions or options for different people to invest in, whether they're retirees or they're just starting out in their investing life cycle and getting out of college and starting their first, building their first retirement account or even their brokerage account and thinking about what makes sense for them. If you're younger, yes, thinking about more growth potential, you have the years ahead of you to build your portfolio. It doesn't mean there shouldn't be a place maybe for some income. Maybe you don't take the income. Maybe you just reinvest the income on a monthly basis and continue to compound that growth and have a differentiated source of income or portfolio versus your normal beta exposure to the underlying indexes or individual names.
We're seeing other issuers, maybe not complete competitors, have reverse splits in their products. What are your thoughts on reverse splits, and how should investors be thinking about reverse splits when investing in cover call products as a byproduct of NAV erosion?
You should go back to understanding what distribution you're receiving compared to, say, the total return of the product. So when you're thinking about a product that has had a lot of NAV erosion, what happened? Were you being over distributed, too much income? So the product couldn't support the income going out, meaning the returns of the underlying product couldn't support the distributions going out. And that's what we keep going back to, Marcos. I think it's really important for your viewers, for anybody thinking about being in the space, to understand what they're investing in. The way we look at our products is we want to, hopefully over time, have the distribution be supported by the total return. We're not looking to over distribute. We're not looking to put out larger numbers than can be supported by the underlying asset. So for us, it's important to kind of fall within that range. And yes, some might look at SPYI at 12% annualized distribution and say that's a very high distribution, while others might look and say that's really low, the low distribution. But for us, with where the total return is and potentially could be, that's the range, that 10 to 12% range for the annualized distribution target, is where we fall in for an S&P 500 product. It changes for each product because each underlying reference asset can have potentially returned or has returned over time different amounts.
What are some common misconceptions that you see about NEOS as a whole, maybe, or just about cover call ETF products?
Some misconceptions would be that you're not really earning income off the product. And we look at it as, if we could source premium out of the volatility of the option market off of that underlying reference asset and provide a monthly distribution from that, and do it in what we consider a tax efficient way, that is important to us. It's different than just owning a fixed income product and receiving income off of that. It's different than earning a straight up dividend off of an underlying equity name. So if you could source those dollars from the option market and distribute that out on a monthly basis, we look at that as something different. Obviously, it's grown a lot in the marketplace. A lot of people do it differently. They do it through different structures, whether it's swaps or equity linked notes. But in the end, we believe it's a place that has that could potentially have a place in everybody's portfolio, and it gives you a different source of income, and it drops away, maybe the duration or interest rate risk you have in your fixed income portfolio, because you're sourcing this from the volatility of a different side of the market. So for us, it's important to have these types of funds in your portfolio and just make sure you understand what you're investing in. And if you understand what you're investing in and you're comfortable with the risk parameters around whatever potential ETF you're invested in, and comfortable with understanding the taxes behind getting a distribution on a monthly basis from one of these products, or some of them do weekly payouts. Ours are all monthly, but understanding that makes a huge difference for the end investor.
How important is the total return metric for NEOS as a whole, and should that be like the most important metric when investors are researching different cover call products?
Yes, when you're researching covered call products and you're looking through each individual one, kind of how we were talking about earlier, I think it's important to use total return as that equalizer, because it includes the distribution. And again, kind of, if you have that fund number one distributes 10%, number two distributes 15% annualized, and number three distributes 50%, and you're trying to figure out which one's the best one for you, which one has the income needs you're looking for, I think going to the total return gives you a good idea of how they're each performing compared to the others, versus maybe the underlying reference asset and how much they're capturing of the upside, or potentially in a flat market, maybe outperforming that underlying reference asset, and then seeing how much income's coming off and how that income's classified from a tax perspective is important as well. So I think the total return definitely plays a huge role in it.
I want to get your thoughts on the term NAV erosion, because a lot of investors, they look at chart, and if it has heavy NAV erosion, they just stay away from it. But what are your thoughts on NAV erosion? Is this something that's super important when investing in cover call products? And how does NEOS, I guess, mitigate that term of NAV erosion?
It's an important thing to think about in this space, because you're getting these distributions. We distribute monthly, some distribute weekly or more. And the NAV erosion term means is your underlying NAV after that distribution not going down by just the distribution amount, which happens on the ex-dividend date. When you actually get that, make it up 50 cents per share, it should go down by 50 cents. But are you continuing to erode the underlying net asset value of the fund by distributing more than it's actually producing from an option standpoint? And if you're distributing more than the actual fund's producing from an option standpoint, or an actual total return standpoint, which is a combination of whatever the options are doing in that fund, whatever the long equities or potentially whatever else is in the fund is doing, if you're eroding that net asset value over time, you're going to have a smaller and smaller net asset value. And yes, people look at it and say, watching a fund's NAV erode over time because you're getting too large of a distribution doesn't make sense. In our view, we want our funds to be able to have the distribution supported by the total return of the fund. So we're not looking to over distribute. when you look at over the funds over a long life cycle. We're looking to hopefully have the fund's total return support those distributions. And that's why we build these annual distribution targets for each fund to see which percentage of distribution can go out for the fund on an annualized basis based on what the total returns are for the underlying plus whatever potential option income we're bringing in that we can distribute out.
I've noticed on NEOS's website that SPYI has outperformed some of its largest income peers like XYLD, JEPI, and Devo, as well as for QQQI, it has also outperformed some of its largest income peers, that being QYLD and then JEPQ. So how is NEOS able to outperform some of its largest income peers? And I think it's pretty fascinating that NEOS has done that.
No, thank you. And I think we put a lot of where we can educational materials on our website, whether that's explaining what we talked about earlier in return of capital, whether that's talking about some of the competitors in the space. And we don't just put the competitors up there to point it out. We put it up there because when we're having conversations with advisors, these are the names that come up the most. So as you mentioned, when you're thinking about SPYI in that S&P 500 income space, those other names you mentioned are going to be the ones that come up in conversation with an advisor, and they want to know how we compare against them. So we always like to look at the total return again of where we are since our inception in August of 22, for example, through the end of last month, and show you what the other competitors have done at the same time. And then we also have what is the distribution range has been for each one. And what we can't show on there is also what might the tax efficiency look like. A number of those funds you mentioned use equity-linked notes or swaps or other types of derivatives to try to have that option exposure. And those are not always as tax efficient as how we build our products. So very different from a tax standpoint, but also really when you're stacking up, total return versus total return, it really can give you a good insight of how these portfolios are performing.
So many investors buy like 20, 30, 40, 50 plus cover call products. In your opinion, at a certain point, is it overkill to do that? And should investors be thinking about maybe having a more simple approach to income investing?
Listen, I think it's down to the individual investor. If they're looking at 30, 40, 50 different positions, and they can manage that, and they're looking at them and they're diversified across different sectors or different names, if they're looking at the individual name covered calls and stuff like that, listen, it's up to each individual investor to make that determination. For me and my portfolio, I look more broad-based to products like our own QQQI, SPYI, and so forth, and still get exposure to Bitcoin and BTCI or gold and IAUI. So very different approach, but everyone's portfolio is different. Everyone's risk tolerance is different. Everyone's income need is different. So if someone has the wherewithal to manage a 50 position portfolio of individual covered call names, then more power to them if they can manage that and be successful at that.
How do you think investors should be reinvesting the distributions from any NEOS product? Should they be investing, or should I say reinvesting the whole entire dividend or just portions of it? And when does it make sense to reinvest the whole entire distribution versus just a portion of it, maybe to use for your own needs?
Sure. Listen, it's, it comes down to the individual person. If you put it in a direct reinvestment plan through your brokerage, it usually does it on that payday. So payday hits, they take the money and reinvest it right into that ETF where you receive the distribution. Some people like to receive all the distributions and then maybe take it and buy, reweight their portfolio. Maybe they weight it towards another sector or another individual name. So for me, I just look at it as I want to be continually invested in the market. So I don't want to, sit in too much cash. And if I am, I'm going to look towards one of our fixed income products like a CSHI or a TLTI for longer duration and think about investing it there if I just want to have some money in on the sidelines, for example. But when you're thinking about reinvesting, it's really up to the individual. If they need some of that money on a monthly basis, take that money out, reinvest the rest, and make sure it's still working for you. It's still in the market. It's still doing something. Because if you like the names you're in, then it makes, probably makes sense to reinvest in those names.
In what market environments do cover calls outperform their underlying reference asset and also underperform?
So people always ask, what's the biggest risk in being in a cover call product? And it's usually missing out on the upside. So when you think about you're selling calls, you're giving away part of your upside. Even in our case, we're selling calls out of the money and we don't cover 100% of the notional. And that can vary month to month. But at some point, you're capping out your upside exposure to that underlying reference asset. And that's why in our case, our strategy is always revolving around volatility and how much notional to cover. And if you're only covering half or 75% of the notional, you could still participate past that point, but you can't fully participate. So that's the risk in a covered call product. You're capping yourself out for that income now, for that premium now. In the flat to down markets, you should outperform the underlying reference asset because you're bringing in that consistent income, that premium on a monthly basis. So in those flat to down, you should outperform from a total return standpoint. But in the big bull rally up markets, that's when you're going to underperform because you're capping yourself out at some point for that income that is being paid out as a distribution.
I know that NEOS is going to be launching their leveraged, or should I say boosted series. So I want to know more about the boosted series. Are you guys excited about it? And why should investors be excited about your guys' boosted series on BTCI, SPYI, as well as QQQI?
Yeah, no, we're very excited about our boosted series. This is going to be, we're going to launch with 3 ETFs. They're going to be boosted versions of SPYI, QQQI, and BTCI. So our S&P 500, our NASDAQ 100, and our Bitcoin products. So we're doing levered versions of those where we're seeking to get up to 1.5 times or 150% leverage to give you not only a little bit more in distribution, but to capture more total return versus saying the underlying reference. So we're really excited about it. We didn't want to go in and try to do a 2 or 3x like some others. We wanted to just do some slight leverage with up to 150 times, under 150%, so 1.5 times. And we're excited about doing it with these 3 products. I think for us, it makes sense. We're doing it a little differently. A lot of people will use swaps to get that, 2x or 3x intraday move in the underlying. We're doing it with options. So we're building synthetic long on top of the portfolios that are already built and giving you a little bit more leverage that way. So it's a little different, and we're thinking about it more long-term leverage. We're not looking at it to be 1.5 times today, the next day, and resetting every day. We're looking at it as more long-term leverage, and we're seeking up to 1.5 times.
Getting the leverage through options versus swaps, is that more cost effective, or is that just better for the fund overall and not using swaps?
It's different for everyone. Every manager has a different view on it. For us, we're option managers, and we want to use the option, potentially option market to bring in that leverage. From our point of view, it could be a little bit more cost efficient versus building out a swap and adding or deleting from that swap on different flows and stuff. So it made more sense for us to dive in and use the option market.
Leverage exposure will be up to 150%, or is it going to be like locked in at 150?
It'll be up to 150.
So like, how does it vary from like every single day?
The goal is to be around 150%. We're not toggling it between 100 and 150. The goal is to be at 150, but it's not always going to be exactly 150. That's why it's giving us that little bit of leeway and saying up to 150%.
And why did you guys launch these products? Is it like, what were the main things you were hearing from investors to launch a levered version of SPYI, QQQI, BTCI? Is it for more yields, better total returns, or is it just maybe they want more risk and more reward?
Yeah, we look at it as what is your risk tolerance. So if you think about boosted QQQI will be more risk on, more equity risk, potentially better returns in the markets that when it's moving higher. And then QQQI is more of the core strategy. And then we have our QQQH, which is our hedge strategy. And so it's really thinking about your NASDAQ 100 exposure and saying, do I want more risk with boosted? Do I want the core with QQQI? Or do I want more conservative and a lower income stream, but a smoother return profile in QQQH with that measure of downside protection. So it's really thinking about your individual risk tolerance and what kind of income you're looking for and what potentially you could get from these types of products. Same across the S&P 500 with boosted SPYI, SPYI, and SPYH. So we're really trying to build out, your risk tolerance and what you're potentially could earn from each individual product. And, for some investors, it might be just sitting in the hedge products because that's where their risk is, their risk tolerance is. Some, it might be saying, hey, I could take more equity risk. I'm willing to take the levered portion of it, knowing that if the market goes south, you're going to have worse returns because of that levered component. But when the market moves higher, it could potentially have not only a little bit more income, but more total return.
Can the boosted series be a long-term investment versus something like a short-term investment? Because when people think of leverage, they think of short-term duration investing versus something like a longer-term duration investing. And do these have daily resets? I'm assuming not.
There are no daily resets. These will be rolled monthly like a lot of our other products. And we're building them out to hopefully be more long-term investments. We're not looking for them to be an intraday trading product.
Why 1.5 times and not something like up to, I've seen other issuers doing 1.25 times, 1.2 times. How did you guys arrive at, let's go with 1.5x leverage?
For us, as we were kind of going through it and building the product, it seemed what was most appropriate for what we were trying to get out to the marketplace and what we were trying to do with these boosted series. So it made a lot of sense to go for the 1.5 times versus a 2 or 3 or even as low as a 1.2.
I know that NEOS also filed for a long-short equity income ETF. So why did you guys file for this fund? I know that this is a super difficult strategy to properly execute. Other issuers are coming out with similar products that they're trying to successfully run long-term, but it's not, I guess, panning out for them. But why does NEOS think that they could successfully run a long-short equity income product?
We're working with a great research provider to help us build out this quantitative model for an equity long short. And that in itself seems to be something that we would invest in, but seems to be something that others have asked us for. And with that, the added option overlay for potentially additional income on top of that, it's really something that people have asked for, and NEOS, being a solutions provider, has been trying to build out this portfolio to help bring this to the marketplace.
I want to know your thoughts on investors taking out unfortunate things like HELOCs, margin, trying to juice up their income from cover call ETFs. So what are your thoughts on investors doing that, in your opinion?
Listen, without knowing anyone personally who's doing that, who's taking a HELOC out or taking a loan out to buy more cover call products or more equities in general, I think it's, if you know what your risk is and you understand what your risk tolerance is for your portfolio and what obligations you would have on the other side to pay back that HELOC or pay back a personal loan or anything like that, I think it's up to the individual person. But I just say, do your homework, understand what you're investing in, understand the risk. What is your potential downside? What is your liquidity if you need the cash out, and so forth. So it's up to the individual person to work through that.
What are your thoughts on investors investing for growth at a younger age and then saying to switch off the growth investing and transfer all that to income-focused vehicles like cover call ETFs?
When you're investing for growth at a younger age, you do that because you have the time on your side. And if time's on your side, you could take more risk. You could potentially grow your portfolio because you have those decades ahead of you of investing and you're not worried about your actual retirement and funding that today. You could grow that over time and take more risk to grow that earlier. So it's always good. I always tell people coming out of school or even when they're in college, to start investing, get involved in the market, buy what you know, build a portfolio, do it with money that you could set aside and you don't need to live on, which is tough when you're just starting out after college and every penny counts. But if there's any amount of money that could be set aside, whether it's going into a Roth IRA or your 401k, if your firm offers one, it's really important to start planning because that money will compound over time. And yes, if one of our products or a product in the space, in the option income space makes sense for your portfolio, great. If it doesn't, maybe it does at some point in your investing lifespan.
The main attraction for covered call products is the ability to hopefully retire eventually and maybe even use covered calls as a way to achieve that goal. So what are your thoughts on investors buying covered call products to hopefully achieve that goal of ultimate retirement?
Listen, retirement looks differently for everyone. And I've learned that a lot over my years. I know people that have retired at 40, and I know people that are 82 years old and still working, not because they need to, but because they want to. So retirement's definitely different for everyone. And if one of our products helps someone feel more comfortable getting closer to retirement, then that's great. Or if it's another product in the space where they understand it and they can continue to help build towards their retirement goals, I think that's great. I think anytime people are investing and understanding how to manage their own investments and grow their investments and eventually get towards that goal of potentially retiring, whether that's at a young age or an old age or potentially never, it's always nice to keep your money working for you in the market.
To wrap things up, what are some things that you think investors should be doing to have long-term investing success, especially with covered call ETFs? And so many ETFs are out now. New issuers are popping out left and right. How should they navigate this really complex covered call space?
I think it all comes back to educating yourself, listening to different, channels like yours, doing the actual legwork and understanding what they're buying and why they're buying it, what kind of risk they're taking, what kind of risk they could tolerate, what their income needs are. And maybe in the beginning, just being more conservative. Don't take out that loan. Don't go on margin to buy it. Maybe it's just dipping your toes in, understanding how these products work. And when you're more comfortable, that's when you can start to expand out more and think about more. But it's all about that initial education and continuing to educate yourself. I look at myself as a student of the market. I'm constantly reading and learning about different things within our market or geopolitical and always trying to understand what's going on and how this might affect our products or the market in general. So I think that constant thirst for knowledge and learning about the sector is really important.
Thank you so much once again to Troy Cates, the co-founder and managing partner of NEOS Investments. If you guys want to learn more about NEOS, you guys can at neosfunds.com. Once again, if you guys like this video, please give it a like because this Q puppy did. Thank you guys so much for watching. Now, once again, this is not financial advice. We are not financial advisors. Do your own research. Investing involves high risk. And I will see you guys on the next one.